This conference will now be recorded.
Hi everyone, it's the Adamus Principle, cunningly entitled Making Sense of Macro. I've changed the title a few times, sorry about that, but this is where it stands, and a little bit unreliable, but I just thought it made sense to keep it simple. And making sense of macro, for those who've done our masterclass, it's an integral part of what we do on the course at the Adamus Principle masterclasses. We've got the man to help me make sense, because I can't do it on my own. We've got the man who has been there, he's done that, and his name is Pete. Hello, young man.
Hi,
How are you?
Patrick. How are you? Yeah, not too bad. Yourself?
Yeah, we were just talking before. I'm very well, thanks. We were just talking before, and it's just every time we talk, like before the show starts, it's just there's something else, another twist,
Yeah.
another confusing kind of picture. I caught a couple of macro agency guys that I'm privileged to get some of their stuff, and they do a webinar similar to what we do, and one of them described it as a moving jigsaw, and all we try and do is to piece together the pieces, because the sands are always shifting, right?
Yeah, the speed of macro right now is incredible. And what used to be multi-year cycle then went down to like, I don't know, 6 months, 1 year cycles, and now it feels like it's changing every 3, 4 weeks. It's incredible. It really is. And you just have to be so flexible and adjust and not getting too stubborn on a story because there's no upside right now.
Yeah, absolutely. I mean, you're absolutely right, and I just think it's important sometimes. We were talking a little bit offline about looking. I always like, when I make sense of macro myself, I always try and talk to someone with more experience, like yourself, and like other guys out there who's if just, or even my colleagues and my peers, just to get to sense check my thoughts, because I don't know everything, and there's a lot of clever people out there that know a lot more than me, and I always say to my students, don't be afraid to ask questions. Don't think you know everything, because it's very there's lots of moving parts, and there's a lot of conflicting views out there, in dollar terms, in risk terms. You still get people out there wanting to buy bargains in risk assets, but it's important to always sense check that, and to look back at what you've done. And we've got a little case study tonight's show. So the first subject we want to talk about is, I'm very privileged to be able to use some charts from Juliette de Klerk. She's from JDI Research. She's ex JP Morgan portfolio manager, of absolute, knows her macro inside out, brilliant. And she was on a podcast show which I'm a huge fan on, called Macro Voices, and I've been a fan for a long time. So I want to just go through some of the charts that really sprung out. If you want to see the show, it's on Macro Voices. They're brilliant guys there. The full show is there, but I cherry picked some of the stuff that has been on my radar, and certainly Beat and myself have been talking about some of the stuff here, and it includes a bit of China, the CMY at $7 shortage. I've been banging on about this for a bit, and I just want to it's nice to see someone else with the similar views and similar things on their radar, and to hear them talk about the same subject but slightly differently. So I've got some charts here. Let me just bring them up. So B, if you can you see that chart now?
Yeah, I can.
So this is just obviously, you can see JDI Research. This is not my chart by any stretch of the imagination, and it's from Juliette de Klerk. She emailed me today, and allowed us to use this. So thank you, Juliet, if you're watching the show. It's a real great asset for you to let me use these. In my simple sort of brain, my simple way, which I like to keep it simple, this kind of confirms what I've been sort of talking about, and certainly Beat, it's been on your radio. It's the dollar liquidity shortage, and this is the global OECD indicator, and basically this measures the kind of state of affairs we're in, and a lot of it is on the downside. So the global liquidity, if you're in any doubt, basically the Fed, which is the dollars of the reserve, the world's reserve currency, and if the Fed rolls off QE, i.e. With QT, then it doesn't just affect the US, it affects every single country in the world. Why is that? Because every single country in the world has to have a certain amount of dollars. That means funding there's a certain element, even if you're trading, Japan trades with the UK, there's an element of you using dollars for that. And if there aren't as many dollars, then that's going to affect it. So this is just a confirmation for that. And obviously, look at these indicators. They are, global manufacturing PMI on the downside, and it kind of runs in line with the dollar liquidity. Right. So that's chart one, and it certainly confirms what your thoughts were as well on this beat.
Yeah, correct. No,
all right.
This topic is usually as well even more interesting for the emerging markets guys, where the actual dollar debt or the actual debt is just in dollars because they try to escape the high yield local market, right? You take Turkey, you take South Africa. So that's why we had this huge move up in dollar EM, or the pressure on dollar EM when dollar yields 10-year was still at 3.25, and EM would have probably completely blown up if we would have made that next step to 3.5, which now obviously everything has changed, and we come to that later.
Yeah, absolutely. So that's a thing that is definitely on my radar, the dollar shortage. So just keep that note of that. So on to the second chart. So this is the Chinese dilemma. This is something you kind of brought to my attention some time ago, and it's a difficult thing that were almost impossible for China, because the Chinese credit channel is clogged due to the yuan stability constraints. Now they don't want to devalue the renminbi, the CNY, for outflow reasons, for all kinds of reasons, and that's why we have this so-called peg at 7 on dollar CNY. And this is interesting, isn't it? Because they're in a kind of constrained position, and it makes it very difficult for them. On the one hand, they don't want outflows, but on the other hand, they don't want a stronger dollar, and that's why to date they've been capping it through dipping into their reserves. At the moment, the last figures was to the tune of 50 yards over the last 2.5 months. Not really confirmed as such, but that's the figure I got from someone. And 7 has been a target, a cap, a target. And B, I know you've got some strong thoughts on this, and maybe you'd like to share that.
Yeah, to be honest, I think discussed probably the last 2 months or 2 months and a bit, where the damage to China to let 7 break. I mean, on this graph, it's actually even a polite graph if you look at the green level of the CNY or CNH. When I send my monthly chart out, it's even more clearly visible what happens when we go through 7. But we see it on that chart as well, that when we take out 7, we kind of see where dollar CNH has been, prior to sort of settling around that 7 handle. So that would be the so it's more about the signal than the actual whether it goes 705 or 710. Let's be honest, no one cares if it's like, goes up 1% or 2. The problem is more the signal. The market knows where CNH, from how weak it's coming from. And if you're a foreign investor and you just see that the PBOC goes on to the next round of possible devaluation of the renminbi, the only anchor you have is somewhere at 8 or worse, because that's more or less where it's coming from before China started to strengthen the renminbi back in, what was that, 2005, 2006. So the signal you send is one of, not panic, but one of, what, it's not a place to go. It's probably either a place to withdraw, because suddenly the potential currency losses could outweigh the benefits you have in that local market that in itself is under pressure. So I think the signal, so they're trying to do something which is exactly the same the BOJ is doing, because the connection between the currency and the equity market, the signal that it sends globally is you could almost put PBOC and BOJ next to each other. They both have at times to, let's say, massage the effects to avoid the signal of an accelerated move. And then the acceleration is very hard to stop, as we know. Once the market, the PBOC probably successfully avoided the first break a few weeks ago by just absorbing all the outflows. So it's always like step one is, okay, a certain amount of people want to get out, fine, let them go out. There's always a step 2 and a step 3 where a lot of people want to get out. And that's the point where even a central bank at times has to think about, are we prepared to waste God knows how many gazillions of dollars of reserves to try and hold the currency? So I'm absolutely certain if there would be some form of a panic, or if the market just suddenly comes to the conclusion, you know what, China is not the place to be right now, they would probably have to start to let the 7 level go. They will do that gradually. My view was always it's not going to happen in 2018. So far I was lucky, still like 3 weeks ago. But Q1, who knows? It's like this whole, which we're probably going to be talking about later, the whole G20 axis, the trade war axis, all the new political problems that come along with the Huawei arrest of the senior management member. We come to that later. But right now, I just think China has no benefit from what is a 1 or 2% weaker currency from current levels really helping in the bigger story. Nothing. What signal does it send? The send of panic. So there is this kind of, evaluation that PBOC has to make in terms of, what do we benefit from a weaker CNH at this point versus damage on the equity market, the damage just throughout the trust into the Chinese economy. The one thing that still staggers me is that every week we have 1 or 2 officials talking about downside acceleration on the economy. We had actually the CPI out over the weekend, I think months and months, minus 0.3 from up 0.2, right? So, things are not well, which usually you would sort of try to short CNH. But I think, like we both said all along, we don't know whether it's going to break or not. But let's keep it simple. Watch it. If it does break, then we know what's happening.
Absolutely. You always said to me, watch it like a hawk. That's something that's,
remember I sent a chart out during the week when the dollar came off, 682, right? And I always said, watch 682. If that breaks, then a bigger dollar down move is about to happen. I called it on my charts, I called it the Guardians. So 682 has, ever since we came back off the highs for the first time, 682 was like a brick wall on the downside. Yeah. And 7 obviously is the level we watch on the top side. So those 2 levels are the guardians of the dollar, if you want, right? Yeah. Break 7, we're gonna see another big wave in the dollar on the upside. Break 682, 680, you're gonna have a very substantial move down on the dollar. But in between, it's a lot of hype and a lot of emotions and a lot of talk. But those are the two cornerstones to watch, which will give us, not just information about about China, but information about the global dollar. And
because the thing is,
to some extent, risk.
yeah, I mean, totally. Because the thing is, it's not just outflows from China. It's what's this going to do to EM? What's this going to do for a risk-off rally on the dollar potentially? What's this going to do? It's going to be carnage all round.
I mean, the interesting
no one really wants it.
No, the interesting part was, even though it now reversed because of the massive losses on the equity market, if you remember, when we had the first Fed talk, Clarida, and then followed by Powell.
The mixed message on Clarida, yeah.
The only dollar that went down from the Clarida talk and never recovered was dollar emerging markets. That was the only dollar that just gone like, hey ho, let's hawkish that, boom, right? While the other dollars sold off and then came back. Dollar rand and dollar EM in general never looked back. The only time now they're back up or coming back up is the massive moves we had in the equity market last week. Before that, the emerging markets took the Fed talk as just plain, dovish, or let's say less worries about future hikes. And that was a very clear message because I have a high respect for emerging markets trader, because I always feel, right or wrong, that these people think a little bit more. It's easy to just buy and sell euro dollar all day long. Liquidity is there, half a pip spread, so who cares? When you get involved into emerging markets, whether you short the dollar or long the dollar, you have to think you have to have a pretty strong view about what the story is, because the damage you do to your P&L is rather substantial. So that's one of the reasons I'm always watching things like dollar rand, dollar Turkey, some of the major dollar EM, because whether I trade them or not, they give a lot of information about how is the market looking at this development from the Fed, blah 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 blah. Even that G10 is sometimes too complicated, too many stories there, and it takes a lot longer at times until the true story can emerge. While on the EM side, it was a clear message. It only needed one comment from Clarida, and it never looked back throughout the following few weeks. Now we're back to risk off, different story, right? But so the Fed signal was quite significant for the emerging markets world, quite clearly.
Yeah, I was at dinner last night with quite a big EM equities trader, and everything we have been speaking about, he spoke about. It's what the top of his worries was a dollar shortage. So it's out there, yeah, that's all brilliant stuff. I mean, I guess pretty much I can't think of anything else on that side, but I just want to show you a couple more. This is interesting. So this is asset returns have been mind-blowing function of monetary conditions, obviously. So this is we'll come to a little bit. I've got a thing on the credit spreads as well, because the credit spreads have been widening. And actually, at the same dinner last night, there was a credit guy, and he was getting worried about the spreads getting wider and wider. And this here just basically confirms what we've been saying. The SPX year over year, and if you believe the monetary accommodation signal, I think that this is basically, it's calculated with all of the kind of QT interest rates and stuff like this. Obviously, there's a lot more downside to equities, which is what we've been saying for quite some time. So obviously, this chart is quite in depth, and it just confirms what we've been saying, basically. Sell into risk rallies, right?
Yeah, absolutely.
So the final chart from Julia de Klerk JDI research, thank you again, is the thing about credit spreads. Historically, the Fed has responded to financial riot when credit spreads have widened. We're not there yet. I mean, look, we right at the end, you've got high yield OAS, and you've got the Fed funds creeping up there. We're not there yet. If you look at the bandwidths around 2008 on those credit spreads, they're properly blown up. We're definitely not there yet.
Doesn't even look like a thunderstorm right now, right?
It's nothing. But obviously, you know, there's some, and it kind of makes sense, you know, when credit gets hard to obtain, the spreads go a lot wider from less risk or riskless bonds. So all of this is all great stuff, and you know that kind of wraps it on the JDI charts, and you know, it's always great for me to look at what other people are talking about, what their charts do and say, and you know, if you have any questions on that, let me know. JDI is a great outfit. Juliet Declerc's been, you know, coming up with some great charts for. I mean, she's been there, she's done it. For some big banks, and just let me know, and you know, we'll talk about it some more at another point, hopefully. So that's that. The next subject I want to talk about is a case study, G20 last weekend. So again, we were talking about it's always good to look at how we traded it, what happened, did we were successful, were we not? I got a bit lucky. I was long into the weekend at Aussie yen, right? And I took 1995. You know, I just thought there was a lot to be. I only thought a ceasefire was going to happen. It was kind of consensus, but I just felt the market, because it was Christmas, bit of Santa cheer. I thought it would be, you know, it would gap up, and it did. The common sense that you had, Pete, was this is just not going to happen. The ceasefire is what the market expected, and then subsequent to that, we had a very pristine fade opportunity. And I guess the thing that I will just say, you know, from Wall Street, bulls make money, bears make money, pigs get slaughtered. And what this means, if you don't know what it means pigs are greedy and they get slaughtered. So even if you were, you know, you wanted to buy into the rumor or sell the fact or realize, you know, have a view, right? Don't get too greedy. And also, you know, the facts, you know, when those statements came out, that was one thing where you could have definitely started to sell into that risk. But it was, you know, it was the arrest of the Hawaii president that really kicked it a lot lower. I think it was on Tuesday or Wednesday, and that was another point.
Yeah, I think the 800 points on Tuesday was before the Huawei story.
Okay. All right. Well, that's great. I mean, so it didn't help, obviously, when he got arrested. But so I think the point here is just to look at, you know, you either do one thing or the other, but don't get too greedy on it.
Yeah.
So, and always, you know, for fading any rallies, it's important, you know, I caught a thing, Good Luck said that, you know, don't, you know, I like to think for myself, and we all do, but if the market thinks the other way, it doesn't matter how big you are, you're going to get trampled on. And you know, that risk on rally, if you had started fading that with some pretty good size, you could have been really in for a lot of pain, because it, you know, it went, you know, it went far higher than I thought it would have gone. But so it's all about managing your risk. You know, we always talk about this at the damage principle. I know you're bang on your risk there, B, and it's about timing as well. You know,
To be
when are
honest,
you
I
going to
think
start
the
to
a big
realize that?
part is the plan. That's what I always say. It's
Yes.
the plan, and sometimes, as traders, we are obviously very sort of, easygoing people, and I realize when I speak to some of my students how they're surprised that, given that a trader usually isn't, you know, that well organized as in planning. I say, listen, before I go into a trade, okay, I have my view, then I look for my level, then I look where I add. I already know my stop loss because I already, before I have the trade, I know what it costs me if I'm wrong, and there are still a lot of people that go into the trade and only when it starts to move, start to think about, what's happening, where I'm wrong. And if you get into these fast moves, there's sometimes no time. And you get surprised by the intensity of the move, and suddenly you lose a lot more than you planned to lose. So for me, I was just lucky. You were great going long risk into the event. Given my big risk bear view, that was obviously not an option for me, but I just waited for the event to happen. And
Yeah.
luckily the highs were really Sunday night already, right? We didn't go any higher, let's say in Aussie yen, than the high we
Mm.
printed on Sunday night. So you could actually, Monday morning you could start to look at the levels, realize, what, there's actually some risk reward by trading Aussie yen, because I was just of the very strong opinion that, like we discussed, we just got what we expected. And I have never seen the market rally for days on end out of a story that just came out as expected. Okay, Trump
Yeah.
made a big PR. I think what was the key, and I think this is something for people to know, to be smart and to, not being wrong, to be critical and think for themselves, which is something I sent out, I think even Sunday night, maybe only Monday, when you compare the two press conferences. So you had the US one, which played this thing very highly, and you had the Chinese one, which basically didn't mention half the stuff. So this,
Yeah.
for me, has been actually the trigger to accelerate selling risk. If they both would have had the same press conference, the same, feel for it, the same takeaway from it, the same, enthusiasm for it, I would have been a lot more careful. But having seen the divergence between the two already on the press conference, made me already think that yes, they might try to comply, blah blah blah, but the US definitely played it up a lot more. Whether Trump tried to get this Santa rally going or not, I don't know, but it definitely did sort of backfire. And no, I know, when he said, so we had the 800 points on Tuesday, we had a very mediocre Wednesday, as it was the funeral of Senior Bush, so the equity market was closed, and the futures sort of tried to rally to bounce back from the 800 points, but kind of failed. And then on Wednesday night was the arrest, and that's when the
Right.
futures tanked, and then the
Yeah.
CME basically had to impose the circuit breakers. I think
Yeah.
about times, something that hasn't happened too often for overnight trading. And then even when Wall Street came in on Thursday, it looked ugly, right? It really looked ugly, and it comes back to the charts you just showed, I think, and that's why I'm bearish. I think equity market is structurally bearish.
Mm.
For bigger fundamentals, nothing to do with the G20 noise. Yeah, it's exactly that noise. You're gonna get this quick rally, this quick that. To be honest, we're probably subject to more in the next 90 days. There was a lot of rumors on Friday that Trump would be prepared to extend to 90 days. Then Navarro came out to slash that, say no way, it's either a deal in 90 days or trade war. So this is going to be probably the Q1 story already, right there again, as complicated as these last few weeks have been. So I don't see any relief in terms of clearer stories, to be honest.
Absolutely. And the thing about that for me as well, if you missed out on buying the risk, selling the off, um, what that's done for what the whole price action for G20, what that has done and confirmed for me now is absolutely, if I was in any doubt, selling into any risk rallies. I'm not in any more, which I wasn't. But I know for a fact you probably get more of a dead cat bounce. Sorry, a dead cat lift. For anything similar, if there's another can kick in another 90 days, I don't think it will have quite the same lift on risk pairs.
Right.
You're going to get people showing right up, selling that yours. After what happened on subsequent on Monday, Tuesday, and Wednesday. So that was I think is quite important. I'm using TraderMade. The great guys over there. It's a new charging system. I'm still getting to grips with it, but I put up euro dollar. You can see some really. It looks really clean and I know you've been using it for a very long time, and it's such a great a great charting package. And I'm just sort of having a little trial, and being very kind to give me this trial free for a little bit of time, and it's great so far. So this is euro dollar. Just looking at this 113 level, if you look on the 1 year, you've got 113. I kind of thought this was a bit of a non-level. I only liked it because of China. Maybe had some handiwork down there. But then, if you go back to a year, where is it? If you go back to 2 years, there's a little thing here, and it kind of respects it slightly close to that level. So that's just quite nice just to look back. Sometimes when I'm charting, I always like to look back as far as I can. If you put the 3 year on, probably not quite so much here, but it's just quite nice to know. Remember this: markets have very long memories, because markets are made up not of algos, just algos, but they're humans as well. And if I can remember that, and I draw a line on there, then someone else can. And as it took. I mean, that was July 2007 or June, July 2007. But again, it happened a year later.
Yeah.
And we were talking about this as well. So just another little thing to remember for some retail followers we do have. Now, the big one, Brexit, right? I know you've got some plans, Bree. So I'm going to keep my powder dry until you unleash your insight and wisdom to the world. What are you doing with Brexit?
Yeah, let's put it this way. Brexit, even for me, is one of the most challenging things to actually think about, because the story is just changing daily. What we do know, if we assume the vote takes place on Tuesday, is two things. It's either obviously going to be a yes or a no. So that will obviously give us the first kind of reaction. A yes is obviously the straightforward one. You're going to get a rally in the sterling. You're going to get a rally in FTSE. So I think this strange inverse correlation will break in the first instance, because I would think the FTSE has to rally in a relief rally, and I would think that asset managers are probably underweight UK anyway, given the severity of the vote. So we're going to see a sterling rally. My first sort of idea would be we go back up to 133 area, where we sort of topped out of late in the last few weeks. I could actually see us go, to be honest, anywhere as high as 140. Why? I think the initial sterling move will get us to about 133, 135. And then something we already quickly talked offline, the dollar has stored a lot of negatives in the last few weeks, which have been unable to unfold due to the fear or the risk around Brexit. So euro dollar couldn't rally. Cable obviously didn't rally at all, because no one is going to buy the pound. But it sort of contained the upside on euro as well, because obviously the correlation, there's a normal correlation from the dollar, but because a nasty Brexit is bearish for the eurozone, so euro dollar had no interest to rally. Even last week, again, we had 2-3 attempts on the top side, but it just backed off, because there's just no point taking euro too high ahead of that vote. Whether it's going to be 140 or not, I just think when stuff would start to rally, not only do we get a sterling rally on the back of the actual UK news, we get a combined sterling recovery / dollar adjustment for, let's say less hikes being priced in, less hawkish Fed, all the stuff we have been talking about and which we might still talk. Now comes the no vote. The no vote is very tricky. The no vote has various layers. I mean, first of all, we don't have to be surprised it's going to be a sterling sell-off, like on the go. I think we're probably talking 122-ish down to 120, maybe 123. Who knows? So it's very hard to actually foresee how much damage. Why? Because there is a number which I think, you know what, I have it here somewhere. There is a magic number by how many votes she's going to lose and what it actually means. Bear with me, I have it here. So basically, a vote by less than, so if she loses by 1 vote to 75 votes, it would mean that she is politically not dead yet. She could go back to Brussels, try to renegotiate, blah, 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 blah. And only in the next step, we would decide whether or not it's the end of her leadership, and so on and so forth. If she would lose by more than 76, my diagram I'm looking at says that leads straight to a leadership crisis. That is probably the moment that the Labour Party would launch the no confidence vote, and things get worse from there. So the initial move, so now the difficult, so what we know is sterling is going to get hit, FTSE is going to get hit on a no. The difference is by how much she's going to lose. That will determine the follow-up process in this whole Brexit saga. So as we established, less than 76, she might get a chance to actually go back to Brussels, and then she has, I think, 21 days until she has to go back to Parliament to come with a, either with a new deal or whatever. Bigger than 76 would mean most likely no confidence vote. So it could mean if she loses by a lot, we have a risk of no deal, and we have a risk of no government. That is really, and that would probably hurt sterling again, and sterling will probably, drop some more. Now, the other problem with the no is there's a movement going that is called the People's Vote. So there's even some Tories have met Labour Party members over the weekend to start discussing a People's Vote. So the government is at gridlock. There's a view that, okay, let's put it back to the people if we can't solve it, which, we come to that later, is going to have some big implications for the future of politics. But let's just talk about this, about the markets. So if she loses not by too much, or even if she loses by much, what we then have to look out for is, what do the rest of the MPs say? Is there a consensus building around a People's Vote? If you get that consensus relatively quickly, sterling could bounce back very hard and very quickly, because there's no secret right now. The polls look like a narrow win for Remain. Would that be a People's Vote, right? So that's why the yes is the easy part. The no has about 5-6 different options. They go from, obviously, Norway Plus, which is another crap deal, in my opinion. I don't think the Brexit team is going to be happy about that one. It's no Brexit, right? So a no could even mean no Brexit. And that's basically what Theresa May blackmails her party by saying, it's either my deal, no Brexit, or Corbyn. That's what she says. And that's why I always felt there's a small element of me thinking, what if those who want Brexit realize the only Brexit they probably ever get is with the deal from Theresa May? The moment she loses that vote, the Brexiteers will fear a softer Brexit. So that's why the no vote is a very, let's say if you sell sterling on a no vote, do not forget to cover it.
Yeah.
Because it can be that you have to cover it quite quickly. Because the views and the headline noise is going to be all over the place. And there will be people coming out to talk about no Brexit. There will be people coming out to talk about the people's vote, which both cases is bullish sterling. So we could be in really big volatility swings, which, to be honest, from distance, from where we sit, or actually, it doesn't actually matter whether you trade retail or institutional, we will all be overwhelmed by the news flow that follows that vote. The latest I picked up is it could well be that Theresa May will tomorrow announce that the vote is not going to happen on Tuesday. What that means, there could be a small rally, maybe, because the market might see that as she's going back to Brussels, tries to get whatever concessions she tries to get. But I'm not sure on that front. As I said before, I will not trade sterling until that vote is out of the way. Whether I trade the actual vote, I definitely trade a yes vote, but surprisingly, I'll be buying euro dollar because I don't think I'm gonna get my hand on sterling, to be honest. I think it's gonna move so quickly that probably very hard. And the stop entry doesn't work because if the platforms go wide, you're gonna have a very horrible fill. Because I work my bid stops as you do. So if the market goes too big figure wide and I have a bid stop 70 pips higher, I'm gonna be down 270 pips higher, right? So I have no interest to do that. So my plan, and coming back to what we touched up on earlier, is you got to have a plan. Because if you have a plan, you play through all the elements of what you expect. That makes you alert of every news that is going to come out, and your muscle memory will actually tell you what you got to do. So that's why my plan already now is on a yes vote, I'm going to try to buy euro dollar. Going to bounce with sterling. Yes, it may not bounce as much as sterling, but I think it's easier to manage than sterling. So I'm willing to make less money, but be in a currency that I can easier manage. Sterling is going to be literally impossible to manage. And if it flies around, it comes off 2 big figures, rallies 3, comes off 2, you just don't know why it came off. Was it news? Did I miss something? So it's going to be hard. So I think euro dollar could be the sort of easier twin brother to trade around Brexit, and maybe even both ways, because if the initial dip will be hard to sell if you get a no vote, should the vote go ahead. So again, there maybe it's easier to sell the euro. So I might actually stay in euro dollar, trading the sterling story through euro dollar. And yes, it's going to dip less, and yes, it's going to rally less, but it's going to be safer to trade, easier to manage. At least that's my view. I think the liquidity from the platforms will get reduced from the banks because they're not stupid. They don't want to get run over. They learned their lesson from the Brexit vote and things like SMB and other few things. The liquidity will be reduced, I'm sure, and all the platforms will run lower liquidities from all the banks. And obviously, us being on these more mediocre retail platforms, that obviously has a knock-on effect from the mirage liquidity that is out there anyway. So I would advise everyone to be just extremely careful trading sterling, because the news, as I said, there's only one clear news, that's a yes. The no is going to get very complicated. And even it looks like obvious that it's going to collapse, it might be not so obvious depending on how quickly we move to plan B or what the consensus view of the plan B will be. So that is, for me, Brexit. And the latest gut feel is the vote is not going to happen on Tuesday. Because she, by the looks of it, she's just way too short of votes at the moment. Even now, and that's only like 48 hours ago or whatever. So I think I wouldn't be surprised she announces tomorrow that it's not going to happen. What that
Okay.
means, I don't know.
So, quick question. She announces it, this delay. Are you going to fade euro dollar? Because I am at 115. What do you reckon?
To be honest, I'll probably come up with that plan tomorrow morning. I don't, no, the problem is I'm trying to figure out what a delay means, and for me to try to have an educated guess what it means, I would need to know what she says
Mm.
on what the plan is. Is she going to travel to Brussels, or is she just delaying it to do some more work with her MPs and try to convince her own base about it? And then, I'm not sure if I mentioned it already, otherwise I do now. Corbyn, in an interview today with Peston, actually said they thinking of launching the no confidence vote, even if she delays the vote. Before it was just the no confidence vote happens if she loses the vote. Now he's thinking of making a challenge, even if she doesn't hold the vote but delays the vote.
Yeah, he
So
smells blood, doesn't he?
it's becoming a little bit complicated.
Yeah.
On what exactly is the next step if that no confidence vote is happening, right? So that's why I'm a little bit. Well, that would go to your way in terms of fading if that would be the outcome. But I would just love to see if she calls a delay. I would love to know what she's doing with the delay, as in getting busy to change a deal, and that might give a little bit of different spin on because then the moment you think of if she can change a deal that make the deal go through Parliament, would then mean that we get to the more positive side of the Brexit, which
I sort of agree with that. That's a bit way further down. I think if she gets a no, I think that's going to be negative for that trading session, i.e. London. And then
if she delays,
it'll come out. I see it coming out with some announcement going, look, I'm going to take this to Brussels again. But the thing is, how likely is that going to be changed? And all of that in uncertainty, it's negative. So unless there's, you get someone from Brussels, like some big top brass at Brussels going, we're open to making this work in a kind of non-committal way, then I think it will be negative for both euro and cable. But interesting stuff. I mean, we'll be blogging throughout the week. Both of us are avid bloggers on LinkedIn, and myself with Maven, Money Maven. So just stay tuned. And that's brilliant. Thanks for that, B. That's really, really good. Just the important thing is, even if you're wrong or you don't know if the market goes against you, have your plan, set your risk, put your stop in, leave it. It's okay. And not trading as a trade sometimes. In a year from now, you don't know what's going to happen. There could be things that could eclipse what happens Tuesday. There could be a war. There could be anything. So it's just another trading day. If you're a technical trader like myself, trade the levels. I like 115, 115.10 on Eurodollar. Yeah. It's got to be something pretty dramatic for me not to be selling that. That's me.
The one thing which I think I wrote about on Friday is I still have one silly thing in my mind, but for that I obviously need Brexit to go out of the way. Is when I felt that the euro could close the year at 117, 118. But the problem with that view is that would be a purely a view based around the dollar adjustment that I think should have happened were it not for Brexit.
Yeah.
And if you look back, it would be just ironic to be back at 118, the sort of middle rate of the year's range, of being
Yeah.
excited about the euro in the beginning of the year. Then we try to destroy the euro sort of halfway through the year. And now we're back to square one, where we expected the divergence between the Fed and the ECB to close through the euro side by the ECB, starting to end QE end of 2018, talk about the first rate hike in 2019, and suddenly it's actually the Fed that is narrowing the. So from a pure, if you stand back and you look at the two policies, at least what the market has priced in, as well as what the Fed is talking now, the euro should actually be higher. And I hate to say it because I'm a notorious dollar bull and a notorious euro bear, but euro is mispriced, and euro is here because of Brexit and the risks around Brexit. If you can remove that risk, euro will trade quite a bit higher, I feel.
Okay.
But maybe Brexit is going to get kicked into early 2019, which would be a real shame for us, because it's a real burden to have that story around. It just, if you look at the range in euro dollar recently, it can't move right beyond whatever 50, 100 points.
Good stuff. So that brings us onto Jay Powell, Fed Watch. I think, we covered last week, what the OIS curve priced in way before the neutral comment that came out. A slight difference in tone. Lots of talk on macro agencies, lots of talk on Bloomberg. Is it a dovish pivot? Is this, going to be a change of tack? Currently, OIS has one hike priced in for 2019, but we both know, well, I certainly think, and I'm sure you do, we come to the thing where that Powell was just saying, bringing the market into the truth, really, in that, every meeting's live. We're close to the bottom of the band. The band officially now, I've heard it from 3 sources now, is between 2.5, the neutral band that is, between 2.5 and 3.5. We're now at 2.25, sorry, 2.225. And that's, exactly what he said. We're just below neutral of that band. It's quite, that's the band. I just think December is a slam dunk. You were talking about 18 basis points. What's all that about, B?
Well, it looks like that I didn't follow where the sort of percentages in probabilities for the December hike. The only thing I saw on Friday is that we have now just 18 basis points priced for December. So we have taken out, it's just 7 basis points we have taken out, but the market, the signal it sends is the market used to be that certain for a hike, and it isn't anymore.
Yeah.
Right. So yes, 18 basis points is still a higher probability of a hike than a no hike, but it's going to be interesting. When is the meeting? The meeting is not next week, the week after, right? So they still have time to talk early next week.
Yeah.
If they want to get this price still a little bit lower, because I think 18 basis points is still too high not to hike from a market perspective, given they talk about forward guidance and transparency and blah 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 blah. So I think if they feel that if they think of not hiking, they would have to come out early in the week to massage those expectations even more. If there's no attempt in the next few days to put a bigger question mark behind December, I think we have to assume it's going to be a hike in December, which then suddenly leaves a little bit of opportunity for the interest rate guys, given we have taken some expectations out to trade. Maybe the dollar reacts a little bit because the dollar might have slowed down a little bit. But then we back to the conundrum that we discussed. The dollar has never moved weak enough for those interest rates expectations. So Do I really want to start buying dollars at 113.50 in the euro after the dollar hasn't really sold off on the lower expectation in the first place? No, probably not. You know, the risk reward does just not look great, you know. So, you know, and not to forget, we have ECB as well. Right?
That's right. Thursday, yeah.
Right? So
yeah.
I think we have an action-packed week ahead of us where flexibility is king. I would think, you know, it's too complicated, and like we said earlier, you have like 3 big stories, and every day another one is number one, and just needs a lot of fine-tune, a lot of definitely a lot of good risk management as well. And right now I have moved, like I think I've said on my emails, I have moved to chip and charge rest of December. I will not take any macro risk for the rest of the year. There's just no, first of all, December is never that month where you need to, you know, I had a good year, so there's no reason to, you know, just push too hard now. And the story is too complicated to push too hard. You know, it's too difficult to really make the right judgment call at any given point. So I do a hit and run, and like, you know, staying flexible, very flexible for the rest of the year.
Absolutely, and that's fantastic. So that brings us to the end of the session for Making Sense of Macro. I hope you're all well equipped. If you've got any doubts on trading, just sit aside. If you're not experienced in trading some live events, just sit aside. There'll be other days, other opportunities, and just, you know, it is December. Don't ruin your Christmas. Watch that risk. And you know, I've seen Beat seen a bit of pain. He's sat on some good risk desk. I've seen a bit of pain as well, and you know, I've thankfully I've learned from that. And you know, if you're not used to trading a big event, just don't do it. You know, or do it but with smaller size or tight stops or whatever. And that's
Always
fantastic.
Yes,
That's great. And you know, before we go, I want to tell you about, we are. It's not official yet, but I'm sort of telling you, so it kind of is official. But we're launching a brand new product. So it's a Masterclass Pro, basically aimed only for institutional traders. Message me if you are an institutional viewer, if you're back office, or you're an experienced trader but not in spot. So that means credit, it means money markets, it means equities, it means treasuries, but you want to get some spot experience. Drop me a line. More details will follow. And last but finally, and not least by any means, he does an amazing commentary. You know, I'm very privileged to get it. It's absolutely dynamite. A must for any trader trying to make sense of everything. But I don't want to go on too much about it. I want you straight from the horse's mouth. Tell us more.
Yeah, thanks very much for the compliment. Yeah, basically what I do every morning is I'm sending the majors out, major pairs in 4 hourly daily charts. Every pair will have my sort of thinking, the themes that's going on out there, trying to sort of read the market, which way we're heading. I'm running updates during the day, sort of live news, where I add my thoughts to it. So it's all in all, I would say, people like Patrick, you know, the feedback I get from the likes like Patrick, it can be very helpful to, you know, definitely retail trading that's sometimes maybe a little bit further away from the news and may still struggle to put some of the news into the right order to sense when the markets are changing. So I think it's a very helpful tool to learn, but as well, you know, hopefully it helps the people to make money as well. So if you have any interest, just you know, ping me directly or speak to Patrick, and we can talk about it.
Fantastic. Well, it's been a great session, and you know, thanks again, Pete. You know, have a good evening. And you know, both of us blog on LinkedIn, and myself with Money Maven. Just keep in touch. Ping me anything, any market related queries or educational or mentorship queries, and we'll get straight back to you. And thanks again, Pete.
Thanks very much for having me, Patrick. Have a lovely evening.
You too.